Bubbles occur when there's debt, like a debt problem, like it's backed by debts that go bad, and bad debt fuels selling and fuels a contagion and a spread to selling other areas of the market instead of beyond where the bubble starts.
Welcome to Rise Up, where we take a look at this week's biggest stories out there, and we break them down so you can understand what's happening to be able to make better decisions on growing and protecting your portfolio. With everything going on in the marketplace today and the volatility, it can get very confusing. Our mission at Rise Up is to really bring you the very best experts, the best conversations, and people who are actually directly helping clients each and every day to help make these important financial decisions for their lives. If you would like some extra help during this session or anytime after, please go to wealthyon.com for a free portfolio review from one of our experts here at Grimes & Company Wealth Management. My name is Terri Kallsen. I'm a managing partner at Rise Growth. I'm a certified financial planner, and I'm very excited to be with you here today with two of our experts. We have Kevin Grimes, who's the CEO and CIO of Grimes & Company. Welcome, Kevin.
Hi, Terri. Great to be here as always.
Wonderful. And we also have Chris Deeley, who's a CFA, a portfolio expert, and he's also with us from Grimes & Company. Welcome, Chris.
Hi, Terri. Thanks for having me again.
All right, we're going to have some fun today. There's been a lot going on. Let's get into our big three, starting with what's going on with Intel, a 7% surge in Tuesday to close at a 5-month high. It dropped the same on Wednesday. So, what is happening? The ups and the downs. SoftBank, announced a $2 billion investment, and then the U.S. government said it was considering buying 10% of the stake in the company. Some of this is unprecedented. Kevin, can you help us understand what is going on and what should shareholders think?
Sure. Well, I don't know if it's completely unprecedented. I mean, to me, it harkens back to the good old days of the global financial crisis back in 2008. If you remember the TARP program. Yeah. You remember the U.S. government Treasury took a stake in GM and also issued some preferred stock or bought some preferred stock in some of the major banks. And if you think back at that point, these were companies that probably could have faced extinction. Intel's not quite there yet. But back then, the taxpayer made money. An American institution lived to fight another day, saved a lot of jobs. So I look at this situation here, and I think it's not the same, but it rhymes a little bit. I think semiconductors are absolutely key to the economy. They're also key to national security. Intel's important. The government is trying to onshore production of semiconductors. Intel plays a part in that, or could play a part in that. So from that regard, I mean, it makes sense to me. From a shareholder perspective, and firstly, we're not shareholders, but from a shareholder perspective, I guess, like I said, it's a little bit different in the sense that GM was probably facing bankruptcy. The common shareholders were wiped out in that case, or nearly wiped out, and the government kind of came in and saved the company. So at this point, the government's investing alongside Intel shareholders, so it could be a good thing. Some people are arguing Intel doesn't need money. They need to fix their business. I would argue they probably need both. I mean, if the plans to build fabs here in the U.S. and to redefine the business, I mean, those things take a lot of money. And this is a company that's been burning cash for years. So, I'd like to see this get fast tracked. I'd like to see Intel be able to kind of maybe move through regulation quickly, be able to onshore. I mean, let's remember the stock was 3 times higher than it was today, I think, roughly 3 times higher 5 years ago. It's been a long road down, but being aligned with the government and getting tracked through regulation, there could be some advantage there. So, look, they still need a business plan. We'll see what the dilution is for shareholders, but I mean, it's probably a good thing in the long run. And if it's not, then the company probably would have been in big trouble anyway without this proposed investment.
Yeah, Kevin, I think, you reminded me, actually, I was at the University of Chicago in one of their finance classes about 2 years after this all happened. many, many years ago. And I actually got to talk to members of the Fed who actually were making those decisions to invest in banks at that time, invest in GM. So you're exactly right. Maybe a little different, but certainly something we've seen before. Chris, what are your thoughts on this? Competitors such as NVIDIA, yet some analysts believe there's an infusion of capital from the US government isn't the solution. If one of your clients asked you about investing in Intel, what would you say?
Well, Terry, I think I would dovetail what Kevin just said is that honestly, Intel doesn't have a funding problem right now. It really has a technology problem. So I think Kevin's correct in the sense that funding is good to have additional capital because they are building, big plant in Ohio, which costs $28 billion. So they need the funding, but the unfortunate part is they're so behind on technology, both on the chip making side against Taiwan Semi, and then on the chip design side with NVIDIA. So they're way behind now. Could the capital that's being infused in the company help them kind of get closer to the competitors? Maybe. But I would tell clients right now that it's really an execution problem and that it probably makes sense to wait a little bit before you invest in Intel. They have a new management team, which has been successful at other turnarounds, but I would give it a couple quarters before I would think about investing in Intel right now and see what that capital can do and see what the return on invested capital will be for shareholders. So I would take a wait and see approach with Intel right now.
Yeah, exactly. With the new CEO, I think it does make sense. But let's move on to our next story, which has to do with the infamous Warren Buffett effect. So we've been talking about the opportunities in healthcare since January. We've had a couple of healthcare experts come into our show, Rise Up. Clearly, Warren was listening because Berkshire Hathaway took a $5 million share position in UnitedHealthcare last week. Shares of the largest healthcare insurance company in the US had plummeted more than 50% from all-time highs, but after the announcement, they were up 12%. Kevin, over the past 52 weeks, the healthcare sector has been underperforming the S&P by over 30%. Obviously, Buffett's team saw an opportunity. Are there others out there?
Yeah, well, I think it's great that Warren Buffett's taking his cues from Rise Up and he's tuning in. I think hopefully that's helping him out a little bit. But I mean, this is what Buffett always does, right? He takes an activist position in very beaten down names. This is an industry that he knows as well as anybody. I mean, who better to fix an insurance company? Granted, of a different slant, but an insurance company more than Berkshire Hathaway. I mean, it's just I think this is something that makes a lot of sense. They have a lot of insurance and reinsurance holdings. So, look, with regard to healthcare, we talked about this a lot in past weeks. And yes, I think that there is an opportunity here. The question is when. I mean, the whole healthcare industry, as well as some of the consumer staple industries with food processing and food products in particular, are very much under the microscope with the MAHA movement, Make America Healthy Again, under RFK, drug sales practices, regulations. There's just been a lot of scrutiny for the sector. But you got to remember, there are probably some catalysts and maybe even some in the short term. I mean, I'm thinking, when I look at the drug industry, it's like the one area that just hasn't had any sort of tariff resolution. I feel like there's been a lot of resolution with different other sectors and I feel like when you get when we know what's happening and there's some finality or at least some guidance on what's going to be the tariff situation with drugs, that could be a short-term catalyst because they're the last ones to kind of get the turnaround effect from that. And other than that, you just got to remember, I mean, drugs, devices, treatments, these things have to recover at some point. I mean, there could be an opportunity. The bottom line is, look, if humanity is going to advance and healthcare is going to advance, and to be able to buy a sector that's lagged by 30 or 40%, I mean, at some point, I think there's going to be some opportunity there.
Yeah, Kevin, I also think about, he may have been thinking the transformation that's going to take place in healthcare for AI and some of the digital work that's going to get done. I mean, they're still on the precipice, but that is really going to start to drive greater, healthcare experiences. But cost and efficiency, I would think, would go down once they can truly implement AI. But Chris, I want to hear from you. How are you viewing the healthcare sector as a part of a portfolio?
Yeah, just dovetailing what Kevin said earlier, I do think that they did come out today and say with the European deal, the tariff deal, that pharmaceuticals will be taxed at 15%. So that was a positive there, getting back to the tariff issues on pharmaceuticals. So I think that's good news. I think the sector has stabilized a little bit in the past couple of weeks. But when you're looking at portfolios, we always talk about diversifying amongst asset classes. And we obviously want to diversify a large cap portfolio into different sectors. And healthcare is an important sector, but it's been beaten down for a number of years. And when you look at, 30% underperformance to the S&P 500, that last happened, guess when? 2000, when the dot-com bubble. So there's a lot of corollaries between now and 99 and 2000. You look at the percentage of healthcare of the S&P 500 right now, it's 9%. Just a couple of years ago, it was 15%. When was it last 9%? 2000. So there will be a turnaround in healthcare. There is a need. The aging population is still happening. There's a lot of unmet medical needs, a lot of rare diseases that still need drugs. So importantly, I think you always want to have some part of your portfolio in healthcare stocks. But to Kevin's point, it's been a very difficult time to invest in healthcare. And so it's hard to put a big part of your portfolio in there, even if there is some valuation discrepancies when you look at healthcare versus technology. So you probably want to see a little bit more momentum in the healthcare space to add a lot more there. But certainly, as Kevin said, between medical devices and biotech companies and pharma companies, longer term, they will be winners.
That's right. So this might be more of a longer term investment, not a short term investment, which we've seen the Buffett effect really take place for long term investment. Keeping that in mind, our last story is for all of you parents out there who are thinking about paying for your child's educational costs. There's been some changes in new federal tax law. Qualified expenses for the use of 529 plans have expanded beyond college costs, which would cover licensing, tutoring, continuing education, and dual enrollment courses for high school students. And for those of you who are parents, but you also have grandparents, I also want to point out that grandparents can actually contribute completed gifts from their estate, which will lower their estate tax and then give them that back to their children to go to college. So remember, in these 529 plans, growth is tax deferred, and the qualifications for withdrawal are tax-free when you withdraw them. And some states even offer income tax deductions or credits for contributions. So all you grandparents out there, or parents who have grandparents, this might be a conversation you want to have about gifting through 529 plans to reduce your estate, which ultimately provides you tax benefits in the long run. But Chris, I know you talk to a lot of clients about 529 plans and leveraging them for their children's education. Most choose savings accounts, but what are the pros and cons?
Yeah, I think you talked about a lot of the pros here, which is the biggest pro is that you can grow these funds tax-free, and when you withdraw them, you don't have to pay any tax. There's not many investment opportunities where you have that, where you can put the money in, have it grow tax-free, and then take it out and not have to pay taxes. Also, you talked about the state income deductions that are possible in certain states. You talked about the grandparents, the flexibility now with changes in the most recent bill. Not only can it be offered for college education, but it can be offered through K through 12, and that was $10,000 a year. Now it's $20,000 a year. It can also be offered for vocational training, for certificates, and for school for vocational trade. So that's a big change. And a lot of clients used to always say, well, what if my child doesn't go to college? Well, now it's so flexible because you can use it for K through 12, you can use it for college, you can use it for the trade schools. So I think the flexibility is almost one of the biggest pros now. And the cons obviously are if you take out some money from 529 plans for not for qualified education expenses, then you have a 10% penalty and it will be taxed as income. And that some of the plans, the investment offerings are a little bit sparse, so you can't invest in individual stocks and things like that. But overall, a 529 plan makes a great amount of sense for all people right now.
Yeah, for both parents and grandparents, the 529 certainly gives more flexibility than it has in the past and really helps, I think, people still value education, but do it in a tax efficient manner. So let's go on now to our questions. And I want to remind you again, if you would like to go to wealthyon.com to be able to do a portfolio review, please do that. But our big topic we're opening up about is the questions that you have sent in to us. So let's begin with Marco Fontana 2115. It feels like there are massive bubbles at all levels: stocks, real estate, crypto, even debt. How do I manage my portfolio? And this particular question is coming from a 50-year-old when I'm worried about everything is going to collapse. So how do you manage the bubble with the fear of loss here? Chris, do you want to take that one?
Yeah, there's a lot in that, Terry. I think, first of all, a 50-year-old has a number of years till retirement. So they can take some risk, even if there are some concerns about, bubbles in certain areas. There's always worries out there. We're always climbing a wall of worry, whether it's in the equity markets or in the fixed income markets or in real estate. There's always some concerns. Now, certainly when he's putting a portfolio together for him, he wants to make sure that portfolio is right for his risk tolerance, to make sure he has the right asset allocation there, and that he's diversified in those major asset classes. We talked about healthcare, but when you look at equities, you want to be not only in the U.S., you want to have some exposure in international stocks, some exposure in small cap stocks, some exposure in emerging market stocks. So you stay diversified. And also, I would point out, when you look at some of the more speculative asset classes like Bitcoin, just to make sure you have the right position size for your risk tolerance. It certainly is a good diversifier in portfolios, but you want to make sure you're not taking a huge amount of risk, because it is the most volatile asset class that is out there. Even though it has been the best performer, it certainly has the volatility. So I would say, Marco, is to make sure you have the right risk tolerance, make sure your asset allocation is correct. And also, if you need money in the short term, not for retirement, but for something else, make sure you have a cash bucket so that you can use that cash and you're not taking money out. If in fact these bubbles do burst in these markets, he's not having to sell at lows. And I would say that even in this scenario, if the markets kind of blew up, if he had a good amount in bonds, those would be the safety part of his portfolio. And those would provide that ballast and that protection of principal when things start to fall apart.
I agree, Chris. And the other thing I would add is making sure you're rebalancing your portfolio regularly. If it's quarterly or annually, having a recheck of your portfolio, because you may want to trim a few positions that have grown oversized due to the current frothy market. And then you shift those gains to safer, underweight asset classes so that your risk tolerance is now balanced. And then you lock in those profits and keep your risks aligned with your ultimate goals. So those are a couple thoughts on how you might manage through the bubbles. But Kevin, let's go to our next one. And this is Everett, who's in Reading, Massachusetts. I think that's what that means. Everyone is talking about the Mag 7 and how dominant they are in the market. Is it too late? Should I be looking to add or sell? What other investments are better at this point?
Sure. So Kevin, I live in Needham, so not far from Reading. Us Massachusetts people, we know how to pronounce all our towns. So, um, yeah, maybe I could relate this, even enroll in the question that Chris just fielded from Marco Fontana about bubbles. I guess if you were gonna, if there can be bubbles in narrow areas of markets. And I mean, if we look at the broad market right now, I don't think that you can say that there's bubbles, but there are certain pockets I think that you could be concerned about. And obviously Mag 7 would be one that everyone would point to and say, is there a bubble there? And they probably relate it back to the tech bubble in the late 90s and in 2000. And there's a lot of similarities. I mean, back then there was a huge amount of spending on internet infrastructure and fiber and internet components, and changes in technology made a lot of that investment obsolete. And there was, but you got to remember, bubbles are financed, or bubbles occur when there's debt, like a debt problem, like it's backed by debts that go bad, and bad debt fuels selling and fuels a contagion and a spread to selling other areas of the market instead of beyond where the bubble starts. And we're right now, I guess, if you said there was a bubble, it'd be an AI maybe. Sam Altman had a comment, I think, earlier this week where I don't know if he used the term bubble, but I think he said overexcited, which is kind of interesting considering they're raising capital right now. But if you think about the companies that are making the investment right now, I mean, they're still experiencing earnings growth. There's not a debt problem. There's no real debt fuel. So I don't know if it's a bubble, but I do think that they're in the short run that some of these companies in the Mag 7, look, I mean, the valuations are enormous. You see some, maybe not Mag 7 companies, but some AI companies like Palantir with 120 times sales. You see some, a lot of the Mag 7 companies, they're at 50 times earnings, 60 times earnings. I mean, these are enormous numbers. So in the short term, evaluation, can be a problem when there's, it can be an excuse for a pullback, or it can magnify a pullback. So at the end of the day, maybe right now is not the time to be running out and adding these to your portfolio in mass. But look, if there's a pullback, these are the stocks that should be bought, right? I mean, and that's been the playbook. During COVID, a couple of years ago, these stocks were the first to kind of come roaring back. That was the fastest decline in rally ever. And then even just this past March, April, after Liberation Day, it was the fastest 20% down and up. And again, it was the Mag 7 that led. In the long run, you have to own these names. I think just like Bitcoin or some other areas of the market that you want to get exposure to, you have to just try to be patient, be selective on when. So I don't know about timing this, that. My guess would be try to find a better entry point, but at some point you got to have exposure here. I mean, these companies, they experience the network effect. They can grow faster and scale faster than any other company. And if it's left unchecked, they basically become monopolies and unstoppable. And that's kind of what's happening. So, I guess in the long run, one of the biggest risks would be that they get broken up like the monopolies did in the past. Like think of like energy companies and Baby Bells, the phone companies. So yeah, I think that in the short run, I'd say you might want to be careful. In the long run, you got to own these things because there's just long-term waves that are going in that direction. But I think Chris hit the nail on the head. Where if you're, I think part of that question was, what else could you be adding and what looks good? I mean, small cap stocks are trading where they were in 2021, and emerging markets are, they've been up and down and all around, but the MSCI Emerging Markets Index is back where it was in 2017. So there's an opportunity, I think, for these other areas of the markets, these other markets to lead in the next phase here. And look, if we are going to have a Fed cutting cycle, like I think we're going to have, if we can skirt inflation, if things do settle out, then those are the areas of the markets that would benefit from a calming, and that's where you might see some opportunities. So I know we've been saying it for a long time, and you've probably been reading it in all the magazines or columns for a long time. But there will come a time when you're really rewarded for having exposure to other things than large cap tech. You still need large cap tech, but if you're looking for opportunity, it's probably somewhere else right now, like maybe small caps in emerging markets.
Well, that leads us to our third question, Kevin, and it's really around the same theme. And this is Riley from Lincoln, Nebraska. And he asks, what is your favorite long-term investment for someone who has a very high risk tolerance? Kevin, why don't you take that? And then Chris, please add in.
Yeah, Chris is going to get mad at me. But again, Joe's not here, so I can talk about Bitcoin again. So I would say Bitcoin. I mean, look, the bottom line is you got to be really careful about this. I'm going to start a newsletter for clients, just that talks about the cycle and the trending of Bitcoin, because it's not something you can really value because there's no cash flow to value. But in the big picture, you're talking about the best returning asset that exists right now or has existed, really since it's come out. It's also probably the highest volatility asset. But then again, if you look at risk-adjusted returns, you look at like what we call a Sharpe ratio in the industry, where you adjust returns to volatility. It's still better than stocks. It has been better than stocks. The returns have justified the risk. And when I look at, like, I'm a simple guy. I like to look at things like supply and demand. And there's a fixed supply here. Bitcoin might just simply be a spot on a digital register, which sounds boring, but you know what? There's only 21 million of them, and that's it. And it's not like dollars or any other currency or really anything else. It's a fixed number. And demand, you're not talking about people looking to go buy pizzas and soda with Bitcoin anymore. You're talking about institutions getting involved. You're going to see Bitcoin in 401ks. Bitcoin, it's been only probably a year or so now that you can buy it through an exchange traded fund, like a true Bitcoin exchange traded fund in an investment portfolio. The institutional money is going into it. Companies are putting on their balance sheet. You're seeing hedge funds just making a big allocation. I feel like the supply is fixed and the demand is going up. And in the grand scheme of things, that would be something that I would want to add in portfolios. Like Chris said earlier, you'd really want to keep the sizing under control so that your risk is kind of, you put money in. Can you lose that? Sure, it can go down. You want to keep your sizing to the point where you can emotionally feel comfortable if the asset goes down 50%, to the point where you might even buy more if that happens. That's the attitude you have to have when buying these types of securities. I can call it a security now, but I would say Bitcoin. If you want a long-term, high risk tolerance, appropriate investment, that's my choice.
Thanks, Kevin. So now I want to hear what Chris has to say.
Yeah, I would have a little bit of a different take than Kevin, and it kind of has to do with two things we talked about on the call today. One is small cap stocks, and one is healthcare stocks. So when you look at small to mid cap biotech stocks over the last couple of years, they have been just unloved and just had the most terrible time over the last 3 years. And that has a lot to do with the interest rate environment we've been in. Higher interest rates certainly hurt companies that are trying to raise capital. Those hurt those smaller companies, and that's why larger cap companies have done better. But when you look at the landscape going out, as Kevin said, if we're in a rate cutting cycle, that could help small cap stocks, and it could help the speculative small cap stocks like biotech stocks. So I would, if you have a high risk tolerance, because many of these companies obviously don't have revenues, they don't have earnings, they're dependent on the FDA to approve their products. But as we said earlier, the healthcare sector, the aging population isn't going away, and the unmet medical needs are not going away. And these drug companies are doing tremendous work to try to put drugs out to cure or help these diseases. So for a long-term investor that has a high risk tolerance, small to mid-cap biotech stocks is a great place to be for the next couple of years.
I was going to say, full disclosure for Chris, he's a portfolio manager of an emerging biotech portfolio. So he actually knows what he's talking about, but I just wanted to make sure that I threw that in there.
Well, I think in the end, you're both right. And the most important thing is that we know our clients, we know what their risk tolerance is, and everyone has a little different definition of what long-term means, right? But there's going to be a lot of volatility in the next 12 to 24 months. This has to be something you're thinking about holding on to for 3, 5, 7 years so that the long-term actually can come through and it can be a positive in your portfolio. But if you're looking for something short-term, these may not be right for you because of the volatility. So I think you've gotten some good advice from both Kevin and Chris. I would also add thinking about artificial intelligence there's plenty of ETFs that have that. Semiconductors like chips, data infrastructure, and software platforms can certainly be a good long-term idea, but not necessarily just one stock. You might want to think about an ETF and spread out that risk.
Great point.
We're going to also now go on to the 3 big stories to watch for next week. And so we're recording this Thursday. Today, Fed Chair Powell is speaking tomorrow at the Fed's annual gathering of central bankers in Jackson Hole, Wyoming. And the next week, Dallas and New York Fed Chair presidents have events. Kevin, what do you expect to hear?
Well, I think it'll be interesting to see tomorrow with Powell. I doubt that there's going to be anything earth-shattering that comes out. Well, last year there was. If you remember, last year Powell announced that rate cuts were coming, and that was a big deal. That turned out to be one of the bigger Jackson Hole releases, I guess, of information. I'm not expecting that this time around. I don't think that you're going to get anything that's that explicit. You might see Powell lean more dovish, meaning that maybe indicating that the rate cuts are more likely than before. Certainly, he's getting an enormous amount of pressure from Washington to be lowering rates. So you probably see some of that, but no matter what, the markets will probably completely overanalyze it and sensationalize whatever he says, maybe even take it out of context. So, so there could be some market moving news with that. Next week with the numbers, would you say consumer confidence and GDP revisions? I mean, I think both of those are kind of a throwaway just because we're still in that tariff churn. So I think those numbers become more relevant in another quarter or so. The durable goods number, I think that could be kind of interesting. We got a good PMI number. The PMI is a survey for purchasing managers. We got a good number a week or so ago, 2 weeks ago, and so that's what people think is going to happen. And the durable goods is like what actually happened. So it'd be good to see the durable goods number back up what the slightly more positive PMI number was. That would be, I think, a positive. But the big one's probably going to be PCE next Friday.
That's right. There's a lot going on with the Fed this week and next week, durable goods next week. But let's talk a little bit about the PCE price index that's also out next week, which will give us more insight into inflation. Chris, if the numbers aren't good, what would you be advising for your clients?
Yeah, I think PCE, as Kevin said, will be the important reading. PCE is obviously the Fed's preferred inflation measure over CPI. It's more consumer driven. It's less volatile than CPI. So it will be a very important reading. I think if it comes in hotter than expected, obviously interest rates will see a bump up and expectations for a Fed cut will go down. So it could, again, backfire on looking at such thing as small cap stocks and those areas of the market where are more dependent on lower interest rates. But again, these are short-term movements. I don't think I would counsel any clients to make moves based on one inflation reading. Overall, there's a lot of noise because of the tariffs that we've seen, as Kevin just talked about. There's a lot of noise there. So just be cautious on one reading. And I would say that to clients, to keep your allocation the way it is and understand that as time goes on, inflation should come down, as tariffs aren't necessarily, as we've talked about in the past, inflationary. It's more of a tax.
Yeah, so I think you both have given our viewers some really good information to come back again next week to see how these reports are turning out to help you make better decisions. I want to thank you all for watching today. I want to invite you to wealthyon.com to get a free portfolio review from advisors, fiduciaries, just like Kevin and Chris at Grimes Wealth Management and Company. They want to help you think through these important decisions during these times. So I also want to thank our viewers for sending in questions. These were great questions this week. I'd encourage all of you to send us questions, comments, suggestions, whatever it is. And lastly, I really want to thank both Kevin and Chris for your insights and your expertise.
Thanks, Terri.
It's great to be here, Terri, as always. Thank you.
You guys have a great week.
You too.
You too.